Covered calls are supposed to be the safest income trade in options. You own stock, you sell calls, you collect cash. What could go wrong? A lot, actually. In this video, I'll show you why the safe covered call can quietly drain your portfolio, and how pros avoid the hidden traps that most retail traders never see coming. The illusion of safety. Covered calls feel safe because you're selling options against stock you already own. You're collecting premium, reducing cost basis, and generating steady income. But here's the catch. That income often disguises opportunity cost, capped growth, and asymmetric risk. While it looks conservative, the wrong covered call setup can leave you stuck underperforming, or worse, holding a losing stock that keeps bleeding. Trap 1. Capping upside in the wrong market. When you sell a call, you're literally selling your upside. If the stock rallies, your gains stop at the strike plus the premium. That's fine in a sideways market, but deadly in bull runs. Your stock gets called away, you miss huge gains, and you end up reinvesting at higher prices. In short, your income trade just robbed your long-term growth. Trap 2. Selling calls on the wrong stock. Covered calls only make sense if the underlying is worth owning. Too many traders sell calls on stocks that are already down 30%, thinking the premium will offset the loss. But collecting $1 in premium on a stock dropping $5 isn't income. It's denial. You can't save a bad stock with option income. Trap 3. Not accounting for volatility and dividends. When implied volatility drops or a dividend is coming up, your income might not reflect the real risk. Low IV means cheap options and aren't worth selling. Dividend approaching means early assignment risk. Ignoring those factors can mean missing yield or being forced out of your stock early. And suddenly, your safe strategy turns into frustration. The pro approach, covered calls done right. Professionals use covered calls strategically, not mechanically. They sell calls only on stocks they'd gladly hold long-term. Choose strikes 5–10% above current price to allow growth. Sell when IV is high to maximize income. Roll or adjust if the stock rallies fast. Covered calls aren't about passive income. They're about active risk management. To recap, covered calls cap your upside, not your downside. Premiums can't fix bad stocks. Volatility and timing matter. Done wrong, they quietly bleed your portfolio. Done right, they generate disciplined, risk-managed returns. Thanks for joining us. If this opened your eyes to the real risks of covered calls, hit like, subscribe, and comment below. Do you use covered calls, or do they use you?